Welcome, everyone, to our Legal Edge Expert webinar series. My name is Michelle Sim, Senior Legal Writer for Practical Guidance here at LexisNexis. And firstly, today, I'd like to recognise our place in country. Here in the southeast of Melbourne, I stand in the land of the Boonwurrung people, and I'd like to show my respect and acknowledge them as traditional custodians of this land and their elders, past, present, and emerging. I'd also like to pay my respects to the custodians of the land in which you all stand as we meet virtually today. So during this session, we'll provide a 2023 year in review update on developments in ESG regulation and sustainable finance. And we'll then delve into some of the key regulatory issues in this space, impacting Australian companies and the finance sector more broadly. So looking forward to a great discussion. And I encourage you in our audience to submit any questions using the Q&A function, and we'll look to address these at the end of the session. So before we get into the discussion, I'd love to get some input from our audience. A poll question should pop up on your screen very shortly. So please let us know in the poll what topic you're most interested in hearing about today. And while we wait for those poll results to come through, I'd love to introduce our wonderful panel. First up, we have Nick Adkins, partner at Allens. Nick advises on a wide range of financing transactions, and we're pleased to have his perspective today, having worked across a number of green and sustainable finance matters. Nick is also the co-author of the Sustainable Finance topic in LexisNexis Practical Guidance, Banking and Finance. So welcome to the panel, Nick. And next on the panel is Charlotte Turner, Senior Associate in the Climate and Sustainability Risk Governance team at MinterEllison. Charlotte specialises in climate risk governance with particular expertise in greenwashing issues. Charlotte is also the Asia Pacific lead for the Chancery Lane Project, an international legal initiative developing model laws and clauses for managing climate risks. Great to have you on the panel, Charlotte.
Thanks, Michelle. Good to be here.
And last but not least, we have Anne Austin, Head of Sustainability at Lendlease. Anne has worked in sustainability at Lendlease since 2004, and in July 2021 was appointed to her current role. So she's responsible for leading the development and implementation of the sustainability strategy for all Lendlease businesses in the region, and brings a wealth of experience in this area to today's conversation. So welcome, Anne.
Thank you for having me.
Great, and thank you to all our panel for your time today. So might see if those poll results are available. So from the results of the poll, it looks like market practice for sustainable finance is the issue that we're most interested in at 35%, closely followed by greenwashing at 26% and climate reporting and nature-related reporting following closely behind there. So it's great to see we've got interest across the board, and thanks everyone for that input. It's a useful reference for our panelists to sort of reflect on as we run through the discussion today. So I'd like to begin at a macro level. The landscape for ESG and sustainable finance continues to evolve. Just this month, the federal government released its much anticipated sustainable finance strategy for consultation, which aims to provide an overarching framework to drive sustainable finance and investment in Australia. And we're also seeing an environment of increased enforcement activity by regulators regarding ESG matters. So to kick us off, Charlotte, would you like to please provide an update on the key developments in ESG regulation for 2023?
Yes, absolutely. Thanks, Michelle. It's been a big year, as you just set out. Here in Australia, we've seen the Climate Change Bill enshrining Australia's net zero commitment, establishing Climate Change Authority, and implementing a carbon pricing mechanism. Also amendments to the Modern Slavery Act, but the biggest update really here, and a real step change in the reporting landscape in Australia, is that of the proposed introduction of mandatory climate reporting obligations based on the global standards that were released by the International Sustainability Standards Board. And it's proposed that these will be phased in for large Australian corporations and institutions from July next year. And just to sort of give some context and frame how big of an update and a change this is, the ASIC chair, Joe Longo, really underlined the significance of this, saying that the shift to mandatory climate-related disclosures presents the biggest change to corporate reporting in a generation.
That's a great snapshot. Thank you, Charlotte. So we'll discuss in further details that some of those things you've outlined. But before we do, Nick, I'll come to you for an update, please, on the sustainable finance market in 2023.
Yeah, thanks, Michelle. So a lot has been happening. I think similar to what Charlotte said. I thought at the beginning, though, I'd just talk a little bit about what we mean by sustainable finance. Just to give a quick recap to set the scene before we then talk about what we're doing in relation to those products, because sustainable finance can mean a wide range of things. When we're talking about sustainable finance, what we're really talking about is two types of sustainable finance that corporate borrowers are accessing in Australia. The first are proceeds-based products. So they are the ones that follow the APMA green loan or green bond or social loan and social bond principles. And these are products where the proceeds of the loan are going towards a sustainable or green purpose. So those products are largely used for, say, development projects, infrastructure projects, property projects, renewables developments, those sorts of things. And then the second type of product we're seeing a lot in the market and working on a lot, what we refer to as behaviour-based products, and they're the types of loans that follow the APMA sustainability-linked loan or bond principles. And that second type of product can, at least in principle, be used by any corporate borrower. The proceeds of the loan don't necessarily need to be going to a green purpose, but the borrower is signing up to certain sustainability KPIs that they will then implement over the course of the loan, and the margin, the pricing interest rate of the loan is linked to their performance against those KPIs. So we're seeing that a lot in corporate finance. A lot of corporate finance borrowers have been using that. There's been a number of large corporate borrowers during the past year that have taken up sustainability-linked loans, and that market has just been growing exponentially over the last few years. So particularly, the market really took off in Australia in 2021 and 2022. There was a huge increase in the use of both of those types of products in the local market over those years. This past year, so 2023, there has actually been a drop-off in the volumes of sustainability-linked or sustainability finance broadly. And that we're seeing that both in Australia and around the world. And I think there's probably several different reasons that might explain it, some of which are related specifically to the products, some of which are broader themes in the market. To some extent, the lower volumes, reflect lower overall activity in the debt markets over the past 12 months. Interest rates have been increasing, and there's been, which means there's been less opportunistic refinancing. Borrowers are trying to stay with their existing financing packages at the lower rates that they put in place during a very historically low period of interest rates during 2021, 2022. And also a lot of M&A activity, which was driving volumes in those COVID years, has also dropped off as well. And that's partially in response to higher interest rates. So there's sort of a value gap in the M&A market. So volumes are down generally. But then also more related to the products and some of the themes we'll come on to later today, anecdotally, there's also, we're also hearing of some caution in the market from borrowers and lenders around the risk of greenwashing accusations related to the use of sustainable finance. So we'll talk about greenwashing in detail later, but broadly speaking, we are seeing both on the transactions we're working on and hearing anecdotally that some lenders are shying away from providing those products in in challenging sectors such as fossil fuel related sectors, or sectors that have potential for greenwashing risk, and borrowers similarly are reluctant to expose themselves to accusations of greenwashing in those areas as well. And there's been some developments in the market that might also address that over the next 12 months. One of the other things we're seeing, even where borrowers aren't ready to commit at the moment on, for example, at a refinancing point, or where they're putting in place new facilities, is the introduction of what we call sustainability sleeper clauses. So, and what we mean by that is that the borrower will sign up to a financing package, and rather than actually having launching it immediately as a sustainability linked loan, they'll have a clause in the document, or perhaps even the full form drafting of all the provisions that are not yet switched on, and that they commit to introducing the sustainability linked loan over the next, say, 12 months. There's usually around about a 12-month timeline to bring those facilities into sustainability linked loans. So we've seen a lot of that over the past, I guess, year or so, and we'd expect that some or all of those sleeper SLLs to convert into sustainability linked loans over the next year or so. So that might drive a bit more volume into 2024. In any event, sustainability finance is still a big theme in the market, in the financing market, and we're still seeing on most financings that there's some discussion of whether or not to use sustainability finance. So on a lot of most of the new greenfield transactions, particularly in infrastructure, property development, renewables, they are using either green loans or social loans, as the financing product, and also in the corporate finance space, still seeing a lot of corporates looking to access sustainability linked loans. The other thing we're seeing a lot is the sophistication of the market and deepening of the market. So we're now moving from in the early days it was pure sort of loan and bond products, and now we're starting to see that more products are being developed that meet those sustainability linked criteria. And so you're starting to see sustainability linked derivatives, securitization, fund finance, things like bank guarantee facilities. So a wide range of products that are now being brought into the sustainability linked or green finance umbrella. One of the other developments during the year was the update of the APLMA principles that I mentioned before. So in the Australian loan market and bond market, all of the sustainable finance products we're working on are using the APLMA principles that were also developed jointly with overseas organisations such as the LMA. And those organisations also put out guidance principles as well to assist in the use of those principles. And during the course of the year, earlier in 2023, those principles and the guidance notes were updated. And the other thing which is very helpful is those organisations, including APLMA, have put out drafting that you can include in term sheets where there's a sustainability linked loan, and also full form drafting for loan documents that you can use you as a practitioner, or if you're reviewing documents as a corporate, you can actually have reference to those documents. Because before that, some market precedent was being developed. It was really just being developed between law firms and based on previous transactions, and so this provides some sort of standardization of drafting, which is good for the market, and similar to the way that there's standardization of drafting in lots of other areas developed by those organizations. Cut me off if I'm going too long, Michelle.
Yeah, no, those are great insights, Nick. Yeah, appreciate that. Great to hear about that sort of broader scope of products available, and the sort of standardization that you're starting to see. Interesting point as well around sort of the borrower caution, particularly around greenwashing, which is sort of having some impact on deal volumes. So it'll be interesting to sort of see how that plays out in the new year. I'd like to turn now to greenwashing. It's an issue that has received a huge amount of regulatory attention, with ASIC having commenced several greenwashing proceedings since declaring it an enforcement priority for 2023. So, Charlotte, could you firstly outline for us what exactly constitutes greenwashing? And then Nick, if you could then describe how greenwashing occurs in the sustainable finance context.
Yeah, of course. Thanks so much, Michelle. And I think, a good point to make in the context of what's been going on in 2023 about ASIC being really strong in their enforcement priorities of greenwashing following their info sheet 271, which I know we're going to talk about a little bit more later. And also the ACCC released their draft guidance on for companies on making environmental and sustainable claims. And as always, investor and stakeholder pressure continues to drive lots of these where lots of the risk is coming from. So with greenwashing, it's not a new source of law, and it's not even really a particularly new source of legal or reputational risk. But with the sharp evolution of the perception of climate change and sustainability related issues into as a material financial risk, and as sustainability matters are informing and being a deciding factor for consumers and investors, it is really now an acute risk for businesses. And as we've said, a really intense focus for our corporate regulators. And similar to the term greenwashing, we also have a heightened risk now of blue washing, in misrepresentations connected to what we would think of the S in the ESG, the social issues. And it isn't, as I mentioned, anything new. And for any lawyers listening, it's just the law that everybody's familiar with in relation to the prohibition on conduct that is misleading or deceptive or likely to mislead or deceive. And really relevantly in a climate change or sustainability context is the rules that apply to future matters. So, for example, target setting, any future representations must be underwritten by reasonable grounds at the time they're made, with the presumption being that the reasonable grounds aren't held unless you can demonstrate evidence to the contrary. And just really briefly, I'll talk about the sort of four main or common contexts in which greenwashing arises. That being that emissions reduction, target setting, and with the sort of huge pressure to meet heightened market expectations on reaching net zero, target setting, and really from an investor perspective, having a net zero target is now sort of a ticket to play, which has changed enormously from even a few years ago. And also now there's that elevated pressure to set broader nature-related targets, which I know we're going to talk about later on. And it's herein really that lies the risk with this topic, because there's a tension between signaling adequate ambition but not overstating the maturity, the planning, the strategy in order to reach those ambitions. Another bucket or topic of greenwashing that we see is the truth to label. As the bar of sustainability does become higher and more specific and more measurable, this idea of truth to label becomes increasingly important. And certainly companies and financial institutions are being held to much tighter account in their use of terms like sustainable, green finance, sort of the points that Nick was making before. And these have really moved on from being sort of amorphous and therefore broadly defensible to imply a much more defined thing, and therefore a higher standard of conduct. And as you mentioned, we've already seen 3 cases filed by ASIC this year. Thirdly, the broad context in which greenwashing can arise is sort of enterprise branding, and that arises in circumstances where a company draws specific attention to a sustainability feature of maybe one or a couple of sustainability features of a single environmental initiative in such a way that it creates a false impression that all of these features can be extrapolated across the entire brand, and the entire brand and company is sustainable. So it's what that overall impression is creating. And then the fourth bucket, and most relevantly for today, is in reporting and statements that are made to the market in the annual report, and including information that has material impacts on financial prospects in the director's report or the operating review, and those climate related disclosures.
Thanks, Charlotte. That's great. And Nick, did you have any sort of further observations at your end?
Yeah, sure. So, look, Charlotte's given a really great outline of the broader greenwashing issue. I mean, within sustainable finance, it is a narrower scope, but the same general principles apply. So what we mean by greenwashing in that context is really using sustainable finance to exaggerate or mislead around a borrower's green and sustainability credentials. So that can take many different forms. It can come at from different angles, but some of the things that we're seeing, I guess, as risk for greenwashing is where the borrower misrepresents the benefits of individual finance products. So they're saying, a loan is green or sustainable when the sustainability benefits are questionable or limited. And we can talk a little bit about that in a second. About sometimes it's around the public statements and that are made maybe more around marketing than actually reflecting the true nature of the product. So that's an area to be very careful about. Another one that we're seeing, and there's probably more talk around this as we're seeing these products mature, is a borrower committing to sustainable finance, but then not actually carrying through with it properly. So, and I think Charlotte kind of talked about that a little bit in the broader context. So it's where you're making longer term commitments. I mean, this also comes up in the context of the net zero commitments. But if you're committing to a sustainability linked loan, but then actually not putting in place any measures to meet the targets that you've agreed to under those products, so that could be a form of greenwashing because you're announcing that you've got a sustainability loan, and then it's not actually you're not actually leading to a sustainability outcome. From the bank side of things, because this is a borrower issue and a bank issue, so from a lender side of it's similar, so not following through with public commitments. So that can be where banks and lenders have committed to reduce lending to certain sectors or projects, particularly say fossil fuel sectors. Again, where they've made statements around commitment to climate change or addressing climate change, net zero, etc., and then still continuing lending in certain areas. The other problem, and this is a problem for global financial institutions, because they've obviously got things happening all around the world, where the banks are publicising their involvement in sustainable finance in one area, but at the same time they're continuing to lend on unsustainable projects in other areas. So there's been some regulatory action in Europe, for example, about a bank promoting its sustainable finance credentials and then having to withdraw that advertising because of accusations of greenwashing around other more lending that to fossil fuel projects and environmentally damaging projects. So that's just some of the ways that it rises. I mean, it can really take so many forms that rather than trying to be specific about the types of greenwashing, it's actually better to, as Charlotte mentioned, kind of have a higher level sort of in principle. Think about it from first principles. Is what I'm doing misleading? Am I overstating the sustainability credentials of this product or behaviour? ASIC has also. So ASIC and APRA have both said that they, this is a priority, and also the government as well. The new federal government's, said that cracking down on greenwashing is a priority, and both ASIC and APRA have come out with public statements around that. In particular, talking about sustainable finance, but I think that what they mean by sustainable finance is a much broader spectrum than just corporate loans. They're often probably more focused on consumer retail type products in that sustainable finance umbrella rather than the big end of town, but it still can apply to the big end of town.
Yeah, that's right. Absolutely. Sorry to cut you off there, Nick, but absolutely a broad reach, and yeah, really appreciate you sort of covering that lender side. And now, look, I'd love to bring you in, Anne, to sort of speak to the corporate side now, and interested in, of course, how claims of greenwashing actually impact upon corporate borrowers.
Sure. So we've been involved in sustainable finance for a number of years. I'm just getting a bit of an echo there. I don't know.
Yeah, me too.
Yes.
Yeah, coming back through Michelle.
There we Yes, it might be from Michelle's. Yeah, thank you for that. That makes it a bit easier. It's hard enough to talk about this topic. So let me just talk about greenwashing first up, just from the perspectives, particularly being a borrower, because I think we're going to delve into just broader greenwashing experience later. But one of the things that's been really interesting for us is we were fairly early in the sustainable financing journey. You know, we set ourselves some very bold sustainability targets in 2020, and we've connected some of our sustainable financing to some of those achievements. And it doesn't feel long, like 3 years doesn't sound like a very long time frame, but an enormous amount has changed in the world of sustainability in that time. And one of the things that we're mindful of are the practices that were common in terms of how you would define your boundaries of what you should be including as your emissions, etc., has evolved enormously over that period, as well as obviously organizations change shape. You know, you buy companies, you sell companies, so you say at the beginning this is going to be our emissions, and you forecast those, and then your organization during that time period changes quite dramatically, and your whole emissions profile can change. And so it feels quite easy to potentially have, you know, stated something that is now quite radically different along that journey. I'll give one little practical example. The ISSB standards that Charlotte mentioned, there's an expectation that's flowing through those about the types of boundary choices you might make. The Greenhouse Gas Protocol gives you some choices and some flexibility with that, but coming through ISSB, there is an expectation that operational control will become the sort of preeminent choice that people will be making when they're setting the boundaries for what they define as their own emissions. And that's a methodology that wasn't necessarily the methodology being used when we first established our emissions. So some of our business units were using operational control, others were using more equity, share-based, etc. And so during that time, we've kind of become more sophisticated, better educated, and are moving to this more operational control, which actually increases actually the emissions that we are anticipating our organisation will meet. And so from a greenwashing lens, you kind of go into a little bit of a concern around, well, we said this in 2020 and now we've changed it to that. You having to be constantly really transparent around what's guiding that, where the changes are, and being sure that it's not looking like you're trying to gain something for your own favour. It's quite a challenge.
Absolutely, Anne. And when it comes to sort of mitigation, could you talk to some of the strategies Lendlease has in place to mitigate being involved in claims of greenwashing?
Sure. So this is very early days. Obviously, we're all learning about how to manage greenwashing, and in the sphere that I work in, so Lendlease, it's a property company. We have a construction business, a development business, investment management business. So we own assets, we develop buildings, we design and construct them. There are a lot of claims that are made in relation to sustainability, and so we have had to educate all of our corporate affairs and marketing teams in particular, and our legal teams around particularly vague language. So a lot of sustainability claims, to make them appropriately, they are boring and technical, and they sound really inaccessible, and you have to use language such as scopes 1, 2, and 3, and you have to talk about upfront embodied carbon versus downstream emissions. Like there's all this sort of jargon, which for many years, the marketing team and comms team had been trying to, is there a common language way or a plain English way of saying that? Or can we just do an overarching term? And the answer now, unfortunately, is no. We actually have to use accurate and clear terms, and we have to teach people what they mean. So I had, somebody in my team sort of saying, do I really need to reference these scopes, or can I say something else? And I'm like, no, there is nothing else. Scopes are an important part of defining emissions, and they are technically the only way to explain them, and so we have to learn that. So we have been rolling out sort of workshops to explain to people where it's possible to inadvertently be greenwashing, even if they didn't realize they were. And now also involving my team a lot more in looking at any of the communication that's publicly available, be it on websites, be it on our prospectuses, or even social media, so that if we've made a suggestion that something has some sort of positive sustainability credential, that's really clear why. So you would actually have to say something like, instead of saying this building operates in a really green way, you would have to say something like, this building halves the energy consumption of a typical building of its type in Australia. Like, you have to kind of be really clear, which is hard when you've got kind of short expectations around your word count.
It's such a good point, Anne, because, as we mentioned before, the real focus of especially ASIC at the moment is the use of absolute language, or so the way that these disclosures are made, whether in reports or advertising, whatever. It's so important now, being like specific but not selective. The use of disclaimers, all of those things. It's so hard. Important.
In terms of communication and disclosures, I'd like to turn now to climate reporting. And mandatory reporting in Australia is to commence in 2024 for certain large entities. So, Charlotte, could you provide us a brief rundown of the new reporting regime and the staggered commencement dates?
Yes, of course. As you mentioned, the Australian government plans to phase in new internationally aligned. So we've already been talking about the ISSB standards, so aligned standards, mandatory climate disclosure reporting from July 2024 for certain entities. And it proposes a 3-stage approach for that implementation, starting with large entities which satisfy two criteria, and then expanding to other proposed groups from 2027-28 onwards. And I think it's important to, when we're thinking about these disclosure requirements, that over time it's proposed that all companies will fall into the scope of these requirements. So even if it seems like it's not, it's quite a remote thing for your business at some point, these will apply. And so it's proposed that the disclosures would be published as part of, and at the same time as, the company's annual and financial reports, the director's reports and the financial report. And the content of them, of the requirements, is will be set out in the Australian Sustainability Reporting Standards, which are being developed by the Accounting Standards Board. And they released a package of 3 initial draft standards for consultation a couple of weeks ago, and that's open the consultation until March. And so the reporting standards are based upon, as we talked about, the ISSB standards, IFRS S1 and IFRS S2, and it's as we've mentioned, envisioned that these will apply to those entities caught from July 2024. And in terms of IFRS 2 relating to climate related mandatory disclosures, it's sort of based upon the Task Force of Climate Related Financial recommendations, but it's more specific and more granular. And IFRS S2 aligned disclosures need to include quantitative information on a number of matters, for example, emissions reductions target, and current and anticipated impact of climate-related risks and opportunities on cash flow, access to finance, the cost of capital, resource allocation, those sorts of things. And so the draft Australian sustainability reporting standards, they're not proposed to be identical to the ISSB standards, and consistent with the approach foreshadowed in the Treasury's second round of consultation papers. In-scope entities are proposed to require disclosure information about climate risk governance, arrangements, scenario analysis, climate resilience assessment, and although they're based obviously on the ISSB standards, they've been modified to reflect Australian conditions. And in line with the government stated policy approach, there are a couple of key differences. The main one being that the scope for now will be limited to climate-related disclosures, whereas one of the ISSB standards refers to sustainability-related disclosures, which is incredibly broad and captures a huge range of things. Whereas the Australian one, or any reference to sustainability in IFRS S1 with the Australian standard has been replaced with climate. And the reasoning behind this is so that the draft standards can at least initially be applied independently of any broader sustainability reporting framework. One of the other differences in the Australian one is even in circumstances where an entity determines that there are no material risks or opportunities relating to climate issues that could reasonably be expected to affect its prospects, this must be disclosed. And the explanation for the basis of that assessment. So we don't think that there's any material risks. This is why we've come to this conclusion. And in the Australian one with financed emissions under IFRS S2, the international standard, certain entities, asset managers, commercial banks, insurers, they are required to provide additional disclosures taken from the Greenhouse Gas Protocol corporate value chain, that's scope 3 that we're starting to talk about before, related to financed emissions. However, the Australian Accounting Standards Board considers that entities that already apply methodologies set out in the National Greenhouse Gas reporting scheme that already apply those methodologies to measure their scope 1 and 2 emissions may not actually have the information necessary for further disaggregated disclosures. And in light of this, it's proposed that for Australian entities, certainly just for now, would need to consider the applicability of additional disclosures. And even though we've discussed there is a tiered approach to the companies that will be caught by this mandatory disclosure, companies that don't fall within the mandatory regime might actually choose to voluntarily disclose anyway, because of some of the things that we've talked about in terms of attracting capital, especially at this time when investors are really mindful of climate risks in investment portfolios. But I'll end my summary there.
That's great, Charlotte, and thanks for sort of outlining how the differences between the newly released AASB standards versus the IFRS ones. And I'd love to hear how this new climate reporting regime has been received by companies, but Lendlease in particular.
Sure, I think both greenwashing. Focus on greenwashing and a focus on increased disclosure are ultimately good for all of us as a human species. So I want to say that neither of them are easy, but they're really important, and I think show a maturing in people's understanding of the fact that we live on one planet and it needs to survive for all of us to survive. So I think the intent of all these things is really good, and Lendlease has been very confident and supportive of a disclosure climate, we have been disclosing voluntarily on the TCFD, on the Task Force for Climate-Related Financial Disclosure, since we started that journey in 2019, and it's been part of our annual report in the last few years. So I think for us, the first cab off the rank in the ISSB arena, which is climate disclosure, is something that we feel we have got some experience with. I think if you were new to that, if you hadn't been looking at the potential impact of different global warming scenarios on your business, it could be very daunting and difficult to get your act together by July 24. It took us a whole year as an organisation to map different global warming scenarios, and then to workshop with those around the world with our leadership team what we thought the implications of those different scenarios, be it a 1.5 degree warmed world, a 2 or a 3, etc., might be for our business, and therefore then start to put the bones around where there were opportunities and where there were risks. And that's what we've been reporting. One of the things that I think is a big implication for organisations, even beyond that climate risk reporting, is that the piece that Charlotte just touched on, where there's a bit of debate around scope 3. So these are the emissions that we all influence as opposed to can directly control. And in the case of an organisation like mine, we have two main sources of scope 3 emissions, one being from the manufacturing of construction materials and the other being from our tenant power. When you look at the emissions that Lend-Lease plays a part in, scope 3 is really critical. It's over 90% in any given year on estimate of our emissions profile. So it's again, I think it's the right thing that the disclosure is starting to lean into looking at scope 3, because it's so fundamental. But at the same time, those things are extremely difficult to measure. So, in that building materials, stage, at any one time, we can have over 20,000 suppliers feeding into the Lend-Lease beast. And each of those suppliers will have thousands of their own suppliers. And for us to understand the emissions profile of the manufacturing and the running of their business of all of those different suppliers, they each need to have something like an environmental product declaration, which means they've measured their own scope 1 and 2. And some of them come from countries where there is not any focus on that at all. And so it's a really varied space. Some suppliers are deeply sophisticated and are really pushing hard, and others are very small 2 or 3 people, family operated businesses, and don't have either the capacity or the capability to be able to provide the information that we would need to be able to report. So there's a whole lot of proxies and benchmarks, etc., and there's a lot of wrestling as to which of those are appropriate and correct. So it's a very vexed and complex space, and it's not something that can be very quickly and confidently, here's my scope 3 emissions. We have good and thorough estimates, but that's only because we've had 10 years worth of doing life cycle assessments for a number of our projects, and we've been able to draw on that data. Again, other smaller organisations may not have that. So I'm really interested, as this legislation moves through, how do we support that journey so that it's actually real and not something that people are guessing or making up, because there could be some quite significant decisions being made off the basis of that information.
Thanks, Anne, and really interesting to hear, the challenges around scope 3, which many companies are currently grappling with. Now, staying with climate disclosures, but shifting gears slightly, a sustainable finance taxonomy is a tool that can assist companies in their climate reporting. And the federal government has committed to co-funding the development of the Australian sustainable finance taxonomy. So Nick, would you like to sort of explain firstly what a taxonomy does and how it benefits the finance sector?
Yeah, sure. So as outlined by Charlotte, and there's a huge amount going on at the moment as really, I suppose, the federal government in particular is playing catch up on a lot of these sustainable finance and climate related issues. One of the government more broadly has announced a sustainable finance agenda, and that covers a number of different things, including around disclosure and a sovereign green bond program. and fostering sustainable finance, use of sustainable finance more generally. One of the key planks of that is the development of this sustainable finance taxonomy, and led by the Australian Sustainable Finance Institute, ASFI. What we mean by a taxonomy is really that it's a sort of common set of definitions and standards that for sustainable economic activities. So for example, when an activity, a development or a change in a business can be defined as sustainable, or green, or those sorts of words that to date there have been industry-led standards like the APPLMA standards that I was talking about before, but there hasn't been government-wide regulation or mandates around what those terms mean. And as I said, we're playing catch up a little bit because lots of other jurisdictions around the world, Europe and in Asia, the US, have these taxonomies. So Australia will be able to, look to those other jurisdictions and hopefully develop, some common principles with those other taxonomies. Then once people have that common set of understanding what those words and activities mean, then it gives the investment community, lenders, and equity investors more confidence about investing in those sectors and not being investing in sectors or particular activities and then not being accused of greenwashing, because it's kind of been through the discipline of that, the filter to be able to be called sustainable or green or etc. So to maybe break it down a little bit more, because I always find this topic a little bit impenetrable, but based on overseas experience, what that might mean is that an activity will, in order for it to be considered sustainable, an economic activity, that it would have to go through an assessment process, and it might need to meet certain threshold criteria, such as that it contributes positively to climate change reduction, recycling, pollution prevention, biodiversity, those sorts of things. And usually there's also a do not harm criteria as well, which is you have to sort of meet one of those initial threshold criteria, but you also can't cause harm to any of the others. So by reducing climate change, you can't pollute the water, or you can't have an adverse impact in another area. So the first phase of this was announced on 1 July 2023, and then the first phase is to develop the taxonomy particularly around climate change mitigation screening criteria, and in certain priority sectors, and that the main three that they're focused on initially is electricity generation and supply. And there's a much broader transition going on in the economy around that, moving from coal to renewable energy and transmission. Second is minerals, mining and metals, and third is construction and the built environment, which is probably the one that Anne will be most focused on at Lendlease. As I said before, to some extent, the corporate finance space has actually already had a taxonomy of sorts, because the APPLMA principles around green loans and social loans and sustainability-linked loans, have had a filter in them around defining, what sectors and what activities the loan market would consider sustainable or green or social. But the development of a government-mandated taxonomy will be hugely beneficial in providing confidence to the market.
Yeah, absolutely.
And the lenders themselves have also been developing taxonomies, and this will be hugely beneficial in them having confidence around their own internal taxonomies as well.
Yeah. That's right. So moving on now from taxonomy and climate to nature. So I'd love to hear from you, Charlotte, with a bit of background to the recent release of the TNFD recommendations for nature-related risk management and disclosures. And then Anne, we'd love to hear from you as well around Lendlease's sort of nature strategy and how you're tackling that.
Of course, thanks, Michelle. So yes, as you mentioned, we've had a recently released task force on nature-related financial disclosures, sort of following on from the task force on climate-related financial disclosures. And the framework is again a risk management and disclosure framework designed to help and guide organizational reporting and action on rapidly evolving nature risks. And it provides that framework for businesses to consider its interface with nature, the financial materiality of relevant impacts, dependencies, risks, opportunities, and how to transparently disclose its governing strategy, measuring, managing, and target. The publication of the TNFD framework, it's not merely a kind of an additional disclosure consideration for companies. It really reflects the emerging expectation on businesses that they do govern and strategize and manage nature capital through a financial risk lens rather than see nature biodiversity or through that environmental lens. Hoping that the TNFD recommendations will drive greater ambition and in response to those market demands. And it's the framework is based around the TCFD. It has those four pillars of governance, strategy, risk and impact management is the difference with the TNFD, and it provides guidance on assessing and identifying nature-related issues using the LEAP framework or LEAP approach, which is L, locate your interface with nature, E, evaluate your dependencies, A, assess nature-related risk and opportunities, and P, prepare to respond, including reporting material nature-related risks and opportunities. And I think an important point to make when we're thinking about nature, especially as a material financial risk, is that it's been quite a long winding road with climate from the TCFD, where we are today with mandatory reporting coming in. But with nature, we kind of have that climate playbook as a guide on how to do things, and the shift in recognition and reporting on nature-related financial issues is likely to be much more rapid. I'll say with that, Anne.
Yeah, it is likely to be much more rapid, which is really interesting because it's far more immature. So in the carbons and climate space, there's a greenhouse gas protocol. There's some of that taxonomy that Nicholas talks about. At least at some level, there's definitions around things. There's methodology for measuring, etc. But there's none of that in the space of nature. Nature positive. What does that mean? And to what degree is it just in this little moment here, etc. So there's a lot of question marks around that whole nature space that I'm really interested to see, how it plays out. From a Lendlease perspective, we've had nature as part of our sustainability framework for over a decade, and we've always looked at, opportunities to connect with nature, to preserve and enhance biodiversity, etc., on our projects and to manage those risks. But we've had to really start to look at an evolution of that strategy in recent times because of the very clear biodiversity crisis that we're in. We've got 19 ecosystems in Australia on the verge of collapse, and we're seeing things like future iterations of ISSB probably requiring a nature-related disclosure, so that there's a growing expectation that you would have a sophisticated way of capturing your dependencies and your impact and reporting that. So we've just conducted about 200 different interviews, both of our own employees and of our stakeholders around the world in all the geographies that we operate. So we've interviewed our clients, our investors, we've interviewed not-for-profits who love us, not-for-profits who don't love us. We've gone out to the whole market to talk about what they would expect of an organisation like Lendlease in terms of nature and biodiversity, and we're sort of pooling all of that to use that to evolve our strategy. And at this stage, we're very much looking at aligning with the TNFD process to try and more deeply understand our impacts in the field that we're in, it's a legal requirement to understand your direct impacts. You know, when you take over a particular site, you have to do an environmental impact assessment, and you have some sense of your direct impacts. But it's not required to understand your indirect impacts, and this is something we haven't ever really delved into in much detail before. So if you think about it, the indirect impacts is a similar concept to scope 3. So the indirect impact, for example, that an organization like ours might have on nature and biodiversity could be related to a building product, let's say sand that's used in the making of concrete. That sand is dredged from a river somewhere. Does that dredging effect disturb the spawning of certain fish or reptiles or whatever to a degree that's recoverable or not? Do we know? And is that better or worse than marble in your kitchen that's come from a quarry somewhere, and in the making of that quarry, what has been disturbed in the natural environment? Now, that is an enormous undertaking to actually try and understand all of those implications. But I think deeply important to have a crack at it, because I'm sure we will find that our indirect impacts are far greater than our direct ones, just as we know that our scope 3 emissions are far greater than our scope 1 and 2. So it's for Lendlease, really early days on this next evolution of where we're headed. But we really want to not just jump on a bandwagon of suggesting we're going to be net positive anything yet, because until we actually know what that means, it's a very difficult claim to make. Net positive under what definition of your impact on nature and diversity? So I think we've really got to approach this whole nature and biodiversity journey in a way that actually addresses the biodiversity crisis, and that the actions that we're taking are genuinely ones that are going to preserve the variety of species that we all rely on to eat, to live, etc. So yeah, we're trying to do it thoroughly, and we're just beginning. Anybody who's further down the path, who's got lots of tips, I'm all ears.
Certainly an area to watch, and it'll be interesting to see too, ultimately, if there'll be broader sort of scope and opportunities for sustainable finance to actually direct funds to these sort of nature positive initiatives. But that's
I'm sure there will be
on the horizon. Yeah. Now, before we tackle a question or two, I'd like to just come to our final question. Would love a quick round from the panelists. Looking to the year ahead, sort of what do you see as the most significant opportunity in ESG and sustainable finance? Start with you, perhaps Charlotte.
I think as I briefly mentioned before, sort of there are great opportunities to be realised from making strong disclosures, understanding as a business your own risks and opportunities, and harnessing those opportunities in your financing, debt or equity. And it can seem like an overwhelming and massive task. As Anne mentioned before, the scenario analysis for Lendlease took a year, but I think that the important starting point is to harness those opportunities. Is you have to start now, take stock of what your organization is already doing to manage those risks and opportunities, and therefore you can identify the gap, what's required, and map out as an organization your strategies to really realize those opportunities.
Thanks. And Anne?
Well, I just add to Charlotte's, all that work we did on TCFD is available for free on our website, so you don't have to invent your scenarios. Go ahead and use them. This is what we're going to have to do. We're going to have to help each other, because it's too hard to do it by ourselves. I actually want to lean into one of the questions is sort of, where would I hope sustainable financing goes? I think the first question that came up there was something about, would we ever look to supporting, heavy emitting sectors that need to transition? I actually think that is fundamentally important. So if there are people on the call who are in the space of creating sustainable financing products, you know, the likes of our steel manufacturers locally, they have invested enormous amounts of money in what's going to become rapidly, you know, obsolete ways of making steel in a decarbonising world, but they cannot afford, you know, by themselves to be able to retool, etc. So we really need to look at how do we support the industries in Australia that we rely on to make the transitions that we need. So I think if there was a way for there to be sustainable financing products that supported that transition, that would be a really significant move forward.
Thanks. And Nick, just a final comment from yourself.
Yeah, and look, I think there's going to be a lot happening in the next 12 months. But just to pick up that theme that Anne was talking about, and it's also a theme in some of the questions as well. I think the development of the taxonomy on sustainable finance will be a huge milestone, and I think that will actually help with that issue around transition finance. I think, as Anne mentioned, and this goes to one of the questions as well, the biggest opportunity is actually in the sector that's most tricky, because at the moment, parties in the finance market are shying away from lending into high emitting fossil fuels type sectors, but that's actually the area that you could have the most impact in. If you can have some products that actually are appropriately labelled, so you might not call them green or necessarily sustainable. It might be transition finance or some sort of label that reflects the journey. But if we can get into that sector, with the confidence of a taxonomy behind us, and hopefully minimising therefore the greenwashing risk, because you're being true to label but reflecting the journey, then that would have a really massive impact. It might be a stretch to say it happens in the next 12 months, but hopefully at least releasing aspects of the taxonomy might start to be the first steps to those sorts of products coming out, and I think the market is asking for that.
Fantastic, and thanks both for sort of addressing the question there around transition finance that came through. We'll look to address those couple of questions we didn't get to separately after this session. Conscious that I'll have to sort of call an end to this session now because we're at time. But a big thank you to our panelists, Anne, Charlotte and Nick, for a really insightful discussion. Big thank you to our audience for joining us today as well. Have a great afternoon, everyone.
Thanks very much.
Thank you.